you ever wondered what it was like right before the Great Depression started? I remember from a very young age, I was fascinated by that question and what life was like during the Great Depression. How did things go from being so incredibly good to so devastatingly bad so quickly? I would sit there and I would ask my grandpa these questions to see if he had any answers to talk about how did the money just disappear? People were rich, they had abundance, and then suddenly they had nothing. And he would do his best to describe to me the mechanisms and valuation and what the stock market was, and most of it as a young child just, went straight over my head. And for most people, they don't want to consider that when times are good, that things could change in the blink of an eye and the economic pain might be right around the corner. But it's historical reality that some of the most economically painful times are preceded immediately by times of fake abundance. And so if you want to know what it looked like right before the Great Depression, look around, because the reality is that everything that's happening around us right now, economically speaking, both from a theory perspective and from a historical pattern perspective, are flashing warning signs of economic danger ahead. So first, the theory, the boom-bust cycle. The boom-bust cycle, commonly called the business cycle or the debt cycle, is a product of fractional reserve banking and central planning, not a product of free market activity. So here's exactly how this plays out. Imagine with me, we've got a small isolated economy. One person's the banker, one person does roofs, one person makes shoes, one person has cows, and so on and so forth. Closed little isolated economy. Everybody has their gold in the bank, and the bank issues paper receipts that can be redeemed for that gold at any time. But the bank wants to make some extra profit on the side, so he opens up a new service called lending. Now, prior to the bank offering its own lending services, if you or I wanted to borrow money in this economy, it would have to be money that somebody else is not spending. If John wants to borrow from Sally, that means Sally cannot then go spend the money that she just lent to John. Under a sound money standard, that means that debt does not increase or decrease the money supply. The money supply is constant, and saving, spending, and borrowing happen as a result of individual choices based on economic activity and subjective value. But as soon as the bank offers lending services, they are creating new paper that doesn't have any money to back it up. This means that when the bank loans out money, they are lending money into existence. As a result, because they don't have to give up any of their own purchasing power to make a loan, they have the ability to make loans underneath the natural interest rate. They can undercut all other lenders. So the bank starts loaning like crazy, and people have an appetite for borrowing because the interest rate is so attractive. Somebody borrows to fix their roof, to build an addition on their house. That means the construction workers and the roof builders have way more income than they used to, and then they go out and they buy new shoes, they buy new bags for their wives, they have tons of extra income, and then everything that they buy is now income for everybody else, and you have the money start to work its way throughout the economy. Remember, money that was lent into existence that starts to bid up prices, and people feel this artificial boom. They think times are great, incomes are going up, but what they don't realize is that boom was built on debt. At some point, one of those loans has to get repaid. When that repaying of the loans begins, that marks the top of the boom and the beginning of the bust. At this point, the banker has two options. Option number one is to just lower interest rates yet again. This will restart that cycle, and instead of allowing the boom to turn over into a bust, it'll just send that boom up higher. Because instead of actually paying off the debt, people can just borrow new debt to pay off the old debt and continue the cycle. More money floods its way into the economy. As money gets cheaper and cheaper, debt becomes easier and easier, incomes go higher and higher, but eventually something breaks and prices start to skyrocket. If the banker keeps this up, continues to lower rates and flood the economy with more and more money that is being loaned into existence, eventually the money just loses all value. People dump the currency, a bank run happens, they try and get whatever gold is still there, and everything collapses. During that time, a lot of malinvestment took place. People made economic decisions that they would not have made without that new flood of money entering the economy, without that easy debt, which means that certain prices were pushed artificially higher. The hyperinflation that takes place at the end of this path means that eventually everything crashes back down and all that malinvestment is exposed. But the banker does have another path that they could choose. Once they see prices starting to run away from them, they can cause the debt to start to get repaid intentionally. Instead of lowering interest rates to continue printing more money into the economy, the banker can decide to raise rates. This means all new borrowing effectively stops, which means that as debt service payments continue to get made, there's an automatic deleveraging that has to continue to happen. Otherwise, the economic pain that builds if people continue to take on new debt is greater and greater because the cost of servicing that debt is greater and greater. So the banker will continue to increase interest rates until the deleveraging occurs. But what the banker doesn't realize is that this has the same net outcome as that hyperinflationary route, which is that all the malinvestment and all the misallocation of resources gets exposed. Remember, this is something that happened during the boom. The bust is when it's revealed. The damage is done though during the boom when people make economic decisions based on false information. Decisions that they would not have made without that artificial changing of the interest rate and the money supply. So that's the theory, but how does that play out in reality? This is a chart of the federal funds effective rate. Since the Federal Reserve is the central bank, this is just like our story of the bank with the isolated economy. In order to stimulate economic activity, the Federal Reserve started to lower rates in 2001. That caused malinvestment and a misallocation of resources, which fueled the housing bubble before the great financial crisis. But instead of letting that bust unravel, they decided to lower interest rates again, this time to 0. Too scared to try and let the economy handle it, they kept interest rates at 0 for many years before they finally started to raise again in 2016. But towards the end of 2019, when it looked again like the bust was about to come out of its hiding, the Federal Reserve lowered interest rates again to 0 in 2020. All of these were accompanied by increasing amounts of money printing as well, as you know. And in 2021, inflation finally reared its ugly head. And this time, the Federal Reserve decided to try and make the bust happen. And since then, they've been raising interest rates at a faster pace than they ever have in history, in an attempt to force the economy to deleverage. Now, the deleveraging hasn't started yet, with the federal government loading up on debt. Now it's at 33 trillion, and with household debt continuing to rise. However, as a result of interest rates continuing to go up and the money printing stopping, the money supply is actually shrinking, and it's shrinking at a faster pace than it has since the Great Depression. Which means if the theory holds true, we should see signs of malinvestment and misallocation of resources starting to pop up everywhere. Signs of malinvestment are prices getting ready to collapse, overabundance of supply, investments made into things that would not be able to be brought to completion because people misgauged the economic activity that was taking place. They looked at information that was false because it was skewed by the money supply. So, do we see any of these signs popping up anywhere right now? Well, yes, we do. First, we are starting to see inventory pile up across the nation for cars from companies like Jeep, Chrysler, Dodge, and Fiat. And now cars like the Gladiator are seeing their prices slashed by up to $20,000. Remember how just recently it was almost impossible to even find a car for sale. And now we're starting to see prices getting slashed by the tens of thousands. Now, most American car companies are in huge trouble right now, but there's one company in particular that is showing some really insane signs. Take, for example, Fiat. Fiat has 357 dealership locations nationwide. So let me ask you this question. If Fiat has 357 locations nationwide, how many cars do you think they have sold year to date? So far this year, they have sold less than 50 cars per month, which brings their total sales number to 280 cars total sold for the entire year. Fiat has sold less total cars in the entire year than they have dealerships, which leads me to believe that parent company Stellantis is but it's not just cars. Take, for example, Rolex prices, which are things that people who want to feel rich buy. Obviously, that's not universal, but most people buying a Rolex, especially a used one, just want to feel rich. We are seeing used Rolex prices drop and supply surging. Now, one of the major signs of economic hardship is just that the things that people want and need are difficult to attain. So looking at something as superficial as just the price on a chart going up doesn't answer the question, why is it expensive, and is it expensive relative to income? This is important when looking at something like housing, considering that at the moment, 90% of borrowers, all the blue sections on this pie chart, are mortgage holders who have mortgages at a rate below 5%. If you exclude mortgage rates in between 4 and 5%, we're at about 2/3 of mortgage holders have mortgages that are below 4%. And a staggering 26% of mortgage holders have a mortgage below 26%. Considering the fact that if any of these homeowners sell their homes to move, they would be trading that mortgage out for a new mortgage over 7%. This means nobody can afford to sell right now. So both rents and the price to buy are staying extremely high, making the cost of living very painful for most Americans. But one form of debt that is seeing delinquencies skyrocket rapidly is credit cards. Credit card delinquencies are now at 2.77%, which may not seem like a lot, but it's higher than the peak in 2020 before the money printing started. And you have to go all the way back to Q3 of 2012 to find a higher delinquency rate. And considering that the interest rates on credit cards have only recently surged to multi-decade highs, this trend is only getting started. Next, consider the fact that banks are tightening their lending standards at a pace reminiscent of every single peak amidst a recession. In 1990, it exceeded 50. In 2001, it exceeded 50. In 2008, it exceeded 50. In 2020, it exceeded 50. And in 2023, it exceeds 50 yet again. Very simply, money is getting harder to borrow, which means less money in circulation, which means things are about to get tight. Not only that, but the bank crisis looks to be heating up as well, with about 700 US banks now exceeding the FDIC's guidance on the concentration of commercial real estate loans. The boom causes malinvestment and a misallocation of resources that is exposed during the bust. The damage is already there. And finally, if we look at the stock market, this is the valuation history of the traditional 60-40 portfolio of stocks and bonds put together by Crescat Capital. And we can see that typically when this price to earnings level reaches around 30, that is the top, like it did prior to the panic of 1901, like it did prior to the Great Depression, and like it did prior to the tech bubble. But in the last 20 years, we've seen unprecedented amounts of money printing and lowering of interest rates. What does this do? This causes the boom to continue, pushing the valuation of the traditional 60-40 portfolio to 130-year highs. Yes, there has been a correction back down to the exact same level it was at prior to every other major peak. The pain is just getting started. This is what it looks like prior to the bust. This is the inflection point, the change from the boom to the bust. These are the signs. The malinvestment and the misallocation of resources are just now beginning to be exposed. Asset valuations are just now starting to realize the destruction that is built in. And if you aren't positive that your portfolio can withstand the magnitude of the economic shocks that are about to come, and you actually want to be able to grow your wealth through the coming years, then it's time to become a member of Heresy Financial University, where I teach active investors how to do just that. If you're interested, link is in the description below. As always, thanks so much for watching. Have a great day.